All right, and that's the signal to begin. Welcome, everybody. This is Boroughs and Burbs, episode 80. Can you believe it, Roberto, that we've gone 80 episodes?
Unbelievable.
Pinch me. So this is our second time having Stephen Kliegerman or Tomana as our guests.
Third time having Steve, second time with Laura.
Really? We didn't have them both together?
Last time. This is Laura's second time. Steve,
the first time I was solo.
Got it.
I crashed.
So this is Boroughs and Burbs, and I made up this title. How did I do? Who's hot? Who's not on the New York skyline? I thought that was a catchy title. I want to know because you guys are talking to all the mega developers in New York. Bjarke Ingels Spiral, the Billionaire's Row. And so you can speak to what's going on in New York, especially with respect to the changing New York skyline. And is the bloom off the rose, or are they still building as fast and furiously as ever at the high end of the market? So I'll start with that big high end of the market question that everybody likes to talk about, the sexy end of the market. Stephen, Laura, how's it going at the high end?
Well, it's funny because Laura spoke at a BizNow conference this morning, and it was in Queens, so it was focused more on Long Island City and Queens. Although we did speak to this as well. I mean, the high end of the market definitely has a significant amount of inventory, and there's a little bit more coming. But I would say, as compared to 5 years ago, there's a lot less coming. You've got 50 West 66th Street by Excel, which is going up now. That is probably the most prominent luxury tower being built right now. It will surpass 200 Amsterdam as the tallest tower on the Upper West Side. But they're off to a decent start. They've sold a decent number of units. Lisa Littman recently sold, I think, a $40 million apartment there. So kudos to Lisa, and kudos to Excel as well. As you know, Zeckendorf Development's going to be developing 570 Washington, which is going to be a tall tower on the in the Soho West Village district. They're reportedly going to be looking for somewhere in excess of $5,000 a foot on average. So they're really seeing that as kind of the 15 Central Park west of downtown. There's the Disney site that Excel is also going to build on up in the 60s on the west side. That's supposed to be 2 towers. Would assume that they're going to be looking for numbers in excess of probably 3,000, 3,500 a foot there.
Have you seen renderings on that?
There's been some massings. I haven't seen renderings on that. Laura, I don't think they've released anything.
No renderings yet.
Yeah. So the high end is still seeing construction. But I would also say that there's been a little bit of a shift to more boutique-y buildings and less super talls. So you've got buildings like the Benson, which performed very, very well. Those more boutique-y, literally less than 20 unit buildings with very large homes in super high-end locations like Madison Avenue in the 70s. That have become very in vogue. We're going to be bringing a building on the Upper West Side to market. We're in pre-development now. Probably will hit the market in 24. It's a little over 100,000 square foot site, and it's only going to be 36 apartments. So but again, Upper West Side, 3, 4, and 5 bedroom homes.
Where?
So there's still a high demand for really good product. But then, there's a lot of product that's been lingering on the market for a long time. 111 West 57th Street, Central Park Tower, 157 Excel, I think, is just finally selling the final sponsor units there. Super tall is sexy, high end is sexy, but there are only so many billionaires in the world, right? And once they have one apartment, they really don't need a second one unless it's an investment or for family or staff.
So has the trend to more boutique been because of what the demand could possibly be, Or is it because the land that you can purchase, like, for example, on the Upper East Side is only but so big, so you can only build up to certain heights and things like that? What's driving that?
Laura, go ahead.
Oh, sure. I was gonna say it's a combination of both. I mean, definitely, what your FAR is and the parcel that you have, but there's different demand for different product. Some people want to be on the 100th floor looking at the whole city. Some people want an intimate building with 20 or 30 neighbors and a larger floor plate, or the full floor of a full floor apartment in one of those buildings. And
The other thing also is, oh, sorry, Laura, go ahead.
I was going to say it's neighborhood based as well. I know that we'll get into Billionaire's Row, but that's not likely where you would see a boutique building, but more downtown and Upper West Side and Upper East Side, you're going to see those boutique buildings.
Right. And, the other thing is, obviously it is site specific, right? So obviously at 1228 Madison Avenue, you were not able to build a 100,000 square foot building, but there's also risk reward, right? So when you build a really large building, 100 units or more, your timeline for sellout grows exponentially, right?
And the potential of people in the neighborhood complaining about what you're building?
All that too, right? So then, you could always come up against, neighborhood resistance, lawsuits, Article 78 procedures, which can blow your whole, pro forma out the window. But, when you develop a boutique building, it's supply and demand, right? You only have so many units in a building. There's going to be built-in demand. And because usually these units aren't cookie cutter, there may be only one or two of the same type of unit in the building as well. So it's a less risky proposition if you're building the right product in the right location. Okay. Look at, let's use 111 West 57th Street as an example, right? That building started close to 10 years ago at this point. The partners went through a lawsuit. They were fighting with each other. Then, then they had construction delays. Then we hit COVID. The numbers quickly changed very very rapidly. And, where on paper, it looked like, oh my God, the developer is going to make $150 million. And then it's all wiped out, right? So you have to be really careful. You have to know what your market is. You have to diversify your market, and you have to really understand what your competition is. So one of the things that Laura and I and the rest of our team do, is we don't just look at like price per square foot. We don't just look at absorption. We also look at like what's going to be the competition in the next couple of years, and is there going to be a glut of that type of product, and thus it's going to elongate my sales cycle, which is going to reduce my ROI.
So that's the key question. If I'm a Zeckendorf or Aspire and I come to you and I say, I've got a couple of choices, a couple of sites I'm looking at, what do you recommend that I get into? And what do you think I should get away from? It sounds like that I should not focus on being a super tall. I should focus on being a boutique and offering something other than height. I ought to do it in a neighborhood. This is what I think I've heard you say. Do it in a neighborhood that's not already super saturated, that doesn't have a lot of product. Pick a neighborhood that's not overbuilt. And you're saying that above $3,500 a foot, there's a lot of lingering inventory.
Yeah, I think it really depends on where you're building, right? I'm not saying don't build a super tall, but if you're going to build a super tall, understand what the economics of that project are, right? What's your competition? Where do your views really start also, right? Because all of a sudden, you've got a super tall tower where maybe the top third of that building has amazing views, but the other 2/3 doesn't. And, you expect that the top third of that building is going to elevate the bottom 2/3 of that building. And that can be difficult as well. There could be a great disparity between pricing, and you might not hit your marks. Also, what's going to be at the base of that building? Maybe there's going to be a hotel at the base of that building. Maybe there's going to be commercial at the base of that building. So maybe that offsets, the economics a little bit as well. So you have to take all these things into consideration. Look, Zeckendorf built a super tall tower at 520 Park, but it was a limited number of apartments, right? So they hedged their exposure by making it a boutique building, even though it's a tall building with Central Park views, right? So, you know, there's a difference.
What's the definition of boutique? What does that mean in this context?
I would say, you know, when your average unit size is, you know, 3,000 feet or more, you know, in 100 square, in maybe 100,000 square foot site where you're literally having, you know, 30 units in a 100,000 square foot building, that would, to me, would be boutique. Certainly a 12 or 18 unit building is boutique, but I would say, you know, for the high end, anything less than 30 units, give or take, you know, where you have a high level of service, a lot of amenities. I know there's a question about amenities, but a small number of people sharing those units and amenities.
Stephen, those super talls, has it been effective for them to build a lot of staff rooms on the lower floors where there is no view, but yet they can very easily sell those things off and take up a bunch of floors, you know, and monetize it? Or does that not happen?
No, we're definitely seeing it. I mean, in most of the super talls and the ultra luxury buildings, you know, in the base, they do have those staff rooms. And when you look at the deeds and you see that there are, you know, they're listed as studios, obviously.
Do they sell well?
They do. I mean, that you're not getting the dollar per foot that you want, but from a transaction activity and transaction volume wise, they do sell.
Yeah.
Most of the people buying in the super luxe buildings have staff, and it's just whether or not they want them in unit or if they want them in a different area in the building.
Right.
And do most of those have parking in them?
The staff apartments, you know, like Laura said, they usually don't work out on a price per square foot basis, but you know, it's really an amenity for the apartments above more than anything else. We see some demand for staff apartments, but it's not a huge, I wouldn't say it's a huge demand. You know, we've had people like in 200 Amsterdam where we do not have staff apartments, but we do have 1 and 2 bedroom apartments. We had a couple of people ask for, like, you know, maybe buying a second apartment for staff or family member or whatnot. I think more effective, frankly, is building a full floor apartment or a duplex apartment that has a separate staff room or
Within it.
almost within it. That's what I would do, because I think most people who want staff, they want staff. Why? They want staff because they either have children that need help, right, at all hours of the day and night, or potentially they're elderly and they need different types of help, right? Yeah. Well, you don't really want that person 25 floors below you. You want that person like on demand, right? So to me, a better way to do it would be to build it within it. But then again, some of these buildings have, you know, lower floor units that are not very attractive. They look into nothing. So, you know, what are you going to do? You're going to make staff apartments and hope that people buy them.
Yeah.
So we're looking at.
I think we have some brokers on the Zoom actually who probably sold those, who probably have more experience with it than I do actually.
So do any of these 7 buildings or so, I've got 7 super talls on the screen in front of us now, Billionaires Row. Do any of these stand out as winners, and any of these what I would call challenged? And I know that's a little controversial, but
certainly 220 Central Park South was a winner.
Right.
that was the 220 surpassed 15 Central Park West as probably the most successful condo building in the history of New York City.
Why? Design, location?
Not that 15 was any slouch, by the way. Location, you know, really comes down to location and views. I mean, you're fronting on the park, right? So, you know, you've got spectacular views and also timing. I mean, that building came to market, what, 16, 17? Like, it was the hottest market we'd seen in years, particularly at the high end of the marketplace. So I'd say 220 was the most successful. 157 I would personally consider a failure, and I'd say that because almost everybody who bought in that building that resold sold for less than they paid.
Right. I would say
they were the only game in town at the time.
That's kind of what I was going to say. You know, 432 Park and 157 I think were, you know, timing as well. You know, 432 is a bit south of Billionaires Row. You know, unique location. It was a unique design. You know, if everyone knows the building, it's the big square windows right in Midtown. a lot of full floors. And I think that did well because it was a bit away from central, Billionaire's Row, and it had more of a unique design than kind of these all glass skyscrapers that you see.
Yeah. Also, I mean, 53 West 53rd, I would not consider to have been a success. It's been on the market for a very long time. It's still on the market. I know that the family, I believe they were a Singapore-based family that were the initial equity investors, were not very happy with the performance of their investment. So unfortunately, I'd say that was not a success. 520 Park, I think overall is a success. And certainly, Zeckendorf built it. So, we want to be mindful of that, but they got very good prices. I think they only have 2 apartments left, but also they had a very good basis because of the deal with the church there. So so I think that also had something to do with it. When you have a lower basis, certainly your opportunity for success is higher. 111 West 57th Street, as we said, went through a lot of fits and starts. I don't think ultimately financially it's a success, although they are getting very high prices for the units that they are selling.
I have a question regarding, it says 225 West 57. It's actually 217, at least that's the address they're using.
Yeah, thank you.
But when 220 went up, was 225 that they have it here, was that a known entity that was coming? Because I think of Ken Griffin, who spent 200 and whatever million on his apartment at 220, and then all of a sudden he's having his coffee one day and the shade just goes up over his face of 217. I'm like, did he know that? To pay $230 million and not have 360-degree views of the city is kind of wild.
They did know. They definitely knew. As a matter of fact, I believe there was a deal between 220 and 217 to somewhat offset Extel's building a little bit, so it didn't completely block. I think I recall, Laura, do you remember there was something about the land purchase, and they were somehow almost tied together a little bit, and they had to
I forget the exact details of the deal, but I do know, if you're at the top at 220 Central Park South, you're still going to get those 360 views. Yes, you will see this building, but they're not right next to each other. You're not blocked.
I don't know. It seems pretty close to me.
I'll call Ken and ask him.
Yeah, please. Probably a sore subject in my opinion, but
So the pace of building has slowed. So it's not necessarily a bad idea to build a super luxury building and go after the high end of the market, even though people are throwing around this recession word and talking about higher interest rates, and we're in a different environment now. Are we in a different environment for the super rich?
I don't think there is a different environment for the super. The super rich are recession proof unless they're investing with Bernie Madoff, right? So, wealthy people always have money, and frankly, diversify very well, and put a lot of their money into real estate. So, that's the great thing about real estate is you don't have to worry that, it's going to trade on an index and tomorrow you're going to be worth half of what you were worth yesterday, unless you have to sell. I actually find that in recessionary times or tough economic times, that's when the ultra wealthy take advantage of the marketplace and invest more. They're savvy buyers. They understand that, real estate is cyclical. So, to me, like what's going on right now with the banks and the economy, there should be a flight to quality to real estate right now. More people should be investing in real estate right now. More people should be investing in hard assets in general. Matter of fact, as soon as I saw what happened with SVB and potentially other banks, the first thing I looked at other than real estate was what's going on in the gold market. What happened? Gold went up. Why? Hard asset. There's a direct relationship between gold and real estate.
Yeah, I'd agree with that. I think also the interest rates, like Steve said, they don't impact these super rich buyers. They're impacting our sub $3 million market buyers, our first time homeowners. I would say that's really where we're seeing the impact and hesitation, if any.
Yeah. So we've always used to see a lot.
Today, the stock market's up, gold is down, right? But gold surged, as soon as SVB went under. So, there's definitely going to be a flight to quality, and we've seen it. We've already seen it at the beginning of this year. We've done a number of deals at 200 Amsterdam this year alone. We've done a number of deals at Celine. These are high end, even though Celine's a great value at its price per square foot. These are still big purchases, 5, 6, 7, 8, 9, $10 million purchases. Why are those occurring now? Is because people feel a little bit of a softening in the marketplace. They feel an opportunity, but they also realize that their assets are safer in real estate.
So we've always seen a huge number of cash deals, right? Almost half. But in the last year, have you seen that even escalate?
Yeah, I mean, I think we talked about this last time. Just as kind of COVID was waning and we were able to start to do events, I was doing an event with Josh Arcus, and I met a gentleman who was a bigwig at Morgan Stanley, and he was talking about how over $50 trillion of new wealth was created during COVID. $50 trillion. Now that's worldwide, but where does a lot of that money go? It goes to New York real estate. So what did we see? We saw a lot of cash deals, and we saw a tremendous number of parents buying for or with their adult age children. We're still seeing that today. Yeah. We're still seeing a lot of parents helping or buying with their adult age children. And when I say adult age children, I'm talking anywhere between about 23 and 35.
Yeah, and on that note, one thing that I noticed recently that I found interesting, Steve, and we haven't even talked about this, but you think about that, you think, okay, their kid's going to NYU, or they're starting at a hospital here, you think they're going to buy them a studio or a 1-bedroom, but they're even buying them 2 bedrooms for when they visit, or a 2 or a 3 for when they visit, or they can rent out one of the rooms to one of their friends. So they're not just buying for their children in smaller units, they're making some big purchases too.
Yeah,
that's exactly what's happening with a buyer of mine called me and she said, listen, I want to buy for my son, but I want it to be at least 2 bedrooms because I want him to grow into it. He's going to get married, the whole thing.
Yeah,
looking at 2.
Sounds like a mom.
Yeah, but they are.
It's a good problem to have.
Yeah, exactly.
We also see parents buying 2s and 3 bedrooms because they have one adult child already in university in New York City, and the other one is going to be going to university in New York City, or one just got into university in New York City and now one's going to NYU med school. It's unbelievable, and it's happening weekly. This is not a one-off thing. This is
Are you describing foreign buyers? And when I'm imagining this, it sounds like you're talking about people who just came into New York. These are not people who had a $2,000 per foot apartment and traded up. You're talking about new buyers in the market. Are they coming in from overseas to a greater degree?
Both. Steve, I would say yes, I think most of them, it's their first purchase in New York City, but not necessarily foreign. You're seeing people from California, you're seeing people from the Midwest, you're seeing people from the South, but certainly a lot of foreign investors as well.
Yeah, I mean, so, what we see, and Laura and I see all over our sales reports, is definitely foreign investors or foreign buyers buying with or for their children, particularly Chinese, a lot of China, but a lot of locals, local New Yorkers, whether they're from Long Island or, Jersey or Connecticut, West Coasters. It's kind of across the board.
What about India?
We have seen a good number of Chinese investors or buyers for their children. I think a lot of that has come out of the lockdowns in China due to COVID and concerns that the government is getting more restrictive and what's going to happen with Taiwan. So I think there's a lot of flight capital still coming out of China because of that. And what we've actually seen, John and Roberto, is not just your $1 to $3 or $4 million buyer. We're now seeing 5, 10, 15, $20 million Chinese buyers as well, which we weren't seeing for a long time. There was a little bit of a taboo about taking too much money out or getting too much money out or having a flashy purchase. I don't know if you remember years ago, there were buyers that were buying in 157, spending 80, 90, $100 million, and it was hitting the papers and all of a sudden it stopped. We're seeing very wealthy foreigners now start to buy again. And in areas where we never saw them before, like on the Upper West Side. You never saw a Chinese investor come into the Upper West Side. They only wanted to be Billionaire's Row or like super high profile locations. But
Yeah.
now they're realizing that they need to buy where there's opportunity, not just where it's flashy.
Are they parking the money in these super buildings, or are they actually intending to spend more than a month a year there?
No, that I think more intending to spend more time there. The unique thing, and I actually just got off an interview with The Real Deal about 200 Amsterdam, is that like that's a building where people don't park money; they actually live there. Most of the people that have bought at 200 Amsterdam are either primary residences or secondary, and it's not secondary for 3 or 4 weeks a year. It's 4 months, 5 months.
I was there last night. It was very much a community in that building. It was wild. I mean, it is the views from up there are out of this world.
It's beautiful.
Talk to us about that building. Talk to us about that deal, the $21 million deal. You represent that building, yes?
We do. Brown Harris Stevens Development Marketing worked with SJP and Mitsui from day one on that building. So we worked on all the floor plans, the amenities, the layouts.
How many apartments? How is that a boutique?
No, that's not a boutique. What are we, 112?
112.
112 apartments. We're about 70% sold. This particular building, this particular deal, which was sold by Jill Sloan from our Upper West Side office, and kudos to Jill. This buyer was returning to New York City. They had lived on Central Park West at one time. They moved out of Manhattan, and they decided they wanted a new home in New York City. They were not expecting to spend $20 million. They were really looking to spend like $15 million, which I know, is no drop in the bucket, but it's still a far throw from $21 million. Jill and our sales team at 200 Amsterdam, were able to basically show the buyer what a great value this apartment was at even nearly $5,000 a foot. And after an extensive negotiation, and we were, this is kind of negotiations 101 for me. And I've told brokers this a gazillion times as I've trained hundreds, if not thousands of brokers over the years. You're not in the game until you get an offer. I don't care how far away you are. Get me a $1 offer on $1 million apartment. Get me $1 million offer on a $5 million apartment. Now I got something to do. Your job is to negotiate. Our job is to negotiate. And you can't negotiate until you get the parties to the table. We were $6 million apart. No more. We were what? $8 million.
We were more. Yeah, we were
$8 million apart.
So where in this building? So there's 100 units, right? So it's not scarcity. It's not a boutique. It's not 30 units. Did this $20 million apartment, $5,000 a foot, is that at the top? Is it the bottom, in the middle? Was it the beginning?
It was what, the 44th?
It's the 44th floor of the 46th
52. So, this was right at that second to last setback. And we were $8 million apart, folks. $8 million. No one in their right mind thought we could make this deal. As a matter of fact, our client said, "You're never going to make this deal."
Yeah, we didn't sleep for a week. We made it happen.
And we worked it, and we worked it, and we worked it, and we came to terms. So this is a perfect example of there's no offer too low. If I ever hear a broker say, "I have a low offer," change your terminology. Tell your seller, "I'm excited, we got an offer."
Yeah.
Okay. And then it's your job to work that offer.
Yeah.
And I've seen deals. This isn't the first deal I've seen this far apart that's happened.
Yeah.
Okay.
It's the same thing with buyers. Hey, with regard to negotiating, the same thing with buyers. I have so many buyers and they're like, "Where do you think? Where do you think?" I say, we have to make an offer and we will learn a lot of information as to where they actually stand. And let's keep walking forward till we identify where they will trade. And then, we have a potential deal.
I want to talk about amenities. Derek asks about amenities. I don't know if Derek wants to ask the question, but amenities are on everybody's mind since you've said that tallness isn't everything. How important were the amenities in this building? You've also talked about view. So go ahead, Derek. What's the question?
Yeah, no, for sure. And my question really does stem from in the larger buildings, you typically see a huge, push towards, big suite of amenities, 20, 30,000 square foot amenity programming. What's kind of made the cut in terms of when you're getting into a boutique building, obviously less square footage to deal with in terms of amenities, less usage. What are people really looking for right now?
So, and Laura, you can jump into, so amenity wise, definitely one size doesn't fit all. Okay. And what I would say is one of the most important things about amenities is that they're well thought out, well executed, and if need be, well staffed. Okay. So, listen, there's one thing at 200 Amsterdam that I wish we had that we don't: parking. And I would say that if there's one amenity in a luxury building, what I would consider to be, over $2,500, certainly over $3,000 or at $3,000 a square foot, if I could have one amenity in the building and nothing else, I would have parking. Because that buyer wants parking. And it's the one thing we just couldn't have. The site did not qualify for it. It was impossible. So
How valuable is parking? I mean, how valuable is it?
People are paying, we're seeing people pay $250,000, $300,000 for parking. There's parking spots in the city that have traded for $1 million downtown in Soho.
At Greenwich, $500,000 for
500,000, yeah.
This building that I'm talking about, we're going to be bringing to market in 24, hopefully, or middle of 24. 36 units. We only can, unfortunately, by zoning, we can only have 12 parking spots. It's amazing, right? The city, if you're in Brooklyn, they want you to have 50% parking to units. In Manhattan, where you need more parking, they won't give you parking. We're only going to have 12 spots. I think we're going to be asking probably $750,000 a parking spot.
Yeah, and we'll get it. And Derek, just to further answer your question, in terms of amenities, what Steve and I really focus on all of our projects is your amenities have to tailor to that demographic. Who's your buyer? If it's a family building, some sort of children's play area where the nanny can take the kids down. Fitness today is super important, and fitness is always changing.
Yeah.
So we try to,
the amenities that get used,
fitness.
video conference rooms, Zoom rooms, okay, highly used. Pools get used, but it depends on when they're open. And no pool is staffed 24/7, right? So you have to choose your staffing hours very carefully. We get a lot, it's interesting, we get a lot of requests for pools. So then we put them in, and very few people use them because it doesn't work timing wise. Gyms, obviously, or fitness centers are important. Storage, tenant owner storage, very, very important. Community lounges, important. Outdoor space, public outdoor space, very important. The golf simulator at 200 Amsterdam is probably one of the most widely used amenities in the building. It's not just a golf simulator, by the way. You can play almost any sport on it. You can play, you can play baseball, you can play basketball, you can play tennis, almost anything on that. Those are very high in demand. Not many buildings have them, but squash courts is exactly what I was about to say. Squash courts have become very
squash courts everywhere.
Super in vogue. So those are some of the amenities that have been most highly sought after. The other one is a pet grooming room. No one wants to groom their pet in their bathtub, plus it's really bad for the plumbing in the building. So pet grooming rooms, people love their dogs, particularly on the Upper West Side. People really love their dogs. And they want to be able to care for them properly. And then there's like low service things where you bring in vendors, so like a massage room, a treatment room, things like that. At the Smile, which is a rental building on the up in Harlem, we have a salt cave, which is people really enjoy. Experiential showers, game room. Those kind of things are all utilized, but it really depends on who your demographic is. The children's playroom at 200 Amsterdam is widely used because a lot of families with children live on the Upper West Side, and they want to play with their kids outside of their apartment, and during the winter it may be too cold to go outside.
But it's a super nice room too. I mean,
It is. It's a cool room.
So they say they want a pool, they want these amenities. Are they willing to pay for them? So when you're advising Zeckendorf and he says, I can't give him all 10 of those, I can't give him squash courts and dog washing stations and parking. And, am I going to get my money back by putting in all these amenities?
Right. So at this high end of the market, buyers are a lot less monthly cost sensitive and much more
Convenience driven.
and service driven. So we're actually adding staff to 200 Amsterdam right now. We're actually adding amenity programming to 200 Amsterdam right now. So we actually had owners who felt like there wasn't enough going on. So we're going to be bringing in a golf pro every week or every other week. We're going to be bringing in a Pilates instructor. We're going to be bringing in someone to do crafts and things with kids. We're going to increase the budget a little bit by doing that, but the owners want more service. So if they want more service, they have to pay for it. They wanted more staff. We have a huge staff there. They wanted more staff in the lobby. They never want the lobby with less than 2 people. So what happens?
You know what we call that in the suburbs?
Gotta go to the bathroom, so they want us to add another person.
You want to know what we call this in the suburbs? We call it a country club,
Yeah.
right? Seriously, we say, I want the best course and I want a squash court, build me some squash courts, and I want great service, and I want to hang out with those people. So is it one of the drivers that, okay, it's got great amenities and they get used, and I like these people in the building because I'm going to see them in the fitness room. I'm going to see them at the dog washing station. Right. So is there a lot of that going on where they're picking their building, not only based on the amenities, but the fact that it's a fun place to be?
Yeah, Roberto said it, right? We have a real community at 200 Amsterdam. People actually live there, and the people, I have to say, and I don't know, this might come off wrong, but like for people of serious wealth, they are some of the nicest people you've ever met. like
you do have to qualify that.
You'd never know who these people are or what they have by the way they treat others, by the clothes they wear, or by the people they surround themselves with. It's a real neighborhood building, and versus some of the 57th Street buildings where no one really lives there, right? The lights are off all the time. It's kind of sad. You really literally look up at night and 432 Park, 111 West 57, 220 Central Park South, they're dark.
Yeah. Yeah. So can we talk just general about the activity in the market? Like, how are you feeling? Are you guys feeling optimistic that we're moving along? Like, it seemed like we were starting to move along, and then just this past weekend, things have kind of got disrupted a little bit. And it's really, I think it's a bit isolated, but still, there's still some fear out there. And like you said, people are in gold and people are in different things. People are making a lot of different moves. Are you optimistic that we still have some runway here, like into summer? And how do you feel about inventory? And also I wanted to ask about inventory. Inventory, like on the resale side, is very cyclical. Like it's going to be like, we're kind of entering a season where we would typically anticipate a tremendous amount of inventory to come on. It's been moderate. It hasn't been as much as we would have liked, but do the developers try to fall into that same cycle where they release more things come spring because it's the selling season and that type of thing?
So Laura, I'm gonna let you take this because we literally just talked about inventory.
Yeah, sure. So, when we look at inventory, and I'll just define what shadow inventory means for everyone. Shadow inventory are units within a building that have not sold, have not gone into contract, but they're also not on the market. So you have a 100-unit building, 50 of them have sold, 30 are in contract, that's 80. Say they have 5 listed. It means that there's 15 units of shadow inventory that the developer is holding on to. So when Steve and I and our team look at inventory, we look at both. We look at all the shadows sitting in all these buildings that has not yet hit the market, and we look at what's actively listed. And today, that number is less than 6,000. It's close to 5,700 units of new development inventory in Manhattan, which is the lowest it's been in 7 years. That number sounds like a lot. But we, really feel like we're in a slight housing crisis, because when you look at the real inventory numbers, and where those units are, the majority of them are north of $5 million.
Right. Also, the rental inventory is much higher than the
Right.
condo inventory. So, you know, when everyone reads about like building permits and housing starts and everything else, like 90% of that is rental.
Yeah.
You know, inventory is also has to be quantified, right? And I've been saying this for a very long time. There's real inventory and there's aspirational inventory. There's I need to sell or I will sell versus if I get my number, I would sell, right? So at one point we did years ago, we did a big research project and we took a look at like all the inventory, not unit by unit, but like all the inventory within a submarket, and then how much of that inventory is priced higher than 10% over the average sale price for that type of unit, whether it be a 1-bedroom, 2-bedroom, 3-bedroom, etc. And like over 50% of the inventory that was on the market was overpriced by more than 10%. So are those real sellers or are those I'll sell if I can? So to me, inventory levels in Manhattan are never really that high because there's not that many real sellers out there, right? And I think the same thing happens in the burbs. I mean, I know you guys right now, particularly in Connecticut, there's no inventory. Like there's nothing out there, right?
But Steve, tell me, the developers are, that means the developers are almost always in the driver's seat because they have a lever to pull. They can push more inventory out, they can pull it back. Buyers have a finite amount of income, a finite amount, you know, there's no wiggle room. It's like the treasury right now, or, you know, they can't do much, you know, they're very limited, but these guys have a lever that they can like open the floodgates or pull it back. So they have some control.
Well, they definitely have control, and it's good that they have control because if they open the floodgates, that would overserve the market and it would push down prices, right? So there's always a strategy to how developers release units and why they release them at a certain time and how they release them and at what prices they release them. But, you know, there's also, and that's kind of one of the great things about having a division like we have here is like we supply you guys with the full schedule A on day one. So you know what that shadow inventory is and can try to get that released. And I know a lot of you on this Zoom and many of our brokers have taken advantage of that and gotten the sales team on site to release a unit to them that was not released. And how did you even know that existed? Well, because we give you resources to do that. But, you know, yes, there's definitely control of inventory that goes on. If you didn't, you know, then you would basically be cannibalizing yourself, right? Because you
sell your low hanging fruit.
There would be no sense of urgency of a buyer if they knew that there were 30 of the same apartment available at any one time.
Right, that, and also you would be, you know, if you released your whole building at the same time and you have a line that runs from the 3rd floor to the 30th floor, obviously that price increases as you get higher. So your low hanging fruit would sell first and you're left with, you know, all of your expensive units in that line.
Of course, that makes sense. So where are the pain points or the point in the negotiation points right now? Are transfer taxes still potentially negotiable? Are like when you were $8 million apart on this deal, how much of it was not a non-cash type of negotiation?
I would say transfer taxes are definitely almost completely on the table for every new development right now. I don't know anywhere where the developer is getting the buyer to pay them unless it's like the last unit in the building. So transfer tax are on the table. Resident managers unit contribution is on the table. Sponsor's attorney, which is, you know, drop in the bucket, is on the table. I would say at this level of deal, mansion tax is definitely on the table, particularly as it increases. So those are the main ones. And I would say that any deal over 10 million bucks, those are probably being thrown in, but in order to also keep the price higher, right? So, you know, there's that game of keeping the price high and giving the concessions. So here, I think, you know, ultimately the price came down by about 2 million bucks. And then I would say that, you know, there was another 2, 4, 5, 6% in concessions that were given to make the deal happen. Buyer definitely came up a lot more than seller came down.
Yeah, I think you're seeing other incentives too. You know, we see buildings throw in a storage unit. If there are private cabanas on roofs, we're seeing that thrown in. Parking not as much because parking is so in demand. But you know, you're seeing if there's these other incentives, we're also seeing, you know, common charges being covered, you know, for a year or two in certain new developments that are struggling and need to get more activity. So I think everything is on the table, but not
You
necessarily.
just said something that I think is the essence of the whole thing. That, I mean, it's the most important thing in this game of real estate, where there's always a tug of war between buyer and seller. You said that the buyer came up more than the seller came down. And I just want to say, I'm experiencing the same thing in Connecticut. We all sit there at Christmas and we say, I wonder what's going to happen in the spring market. I wonder whether the buyers are going to win, because they're going to say, you know, the economy's cooling. People are talking about interest rates, decreasing buying power, the recession word. I'm going to get a deal. And sellers are looking around and saying, there's not much inventory. I think I'm going to be patient. I think I'm going to wait for my price. And we're all wondering who's going to blink. And you know what? Buyers are blinking. Buyers are now paying, on average, more than 100%. We're seeing bidding wars in Connecticut. You're saying the same thing is true in New York, and that's why we're seeing record rental prices. Yes.
Well, I mean, in rentals, there's such a shortage of rental housing. Laura just rented a new apartment, so she's like,
Oh, I mean, I can chime in there. I mean, the rental market is just crazy. You know, I was going to some showings a few weeks ago for myself and showing up, and people are literally around the block. 60 people looking for, you know, anything that's
But you got it.
No, I wanted them
You
to
didn't say,
out.
do you know who I am?
Yeah,
You didn't
right?
pull that?
we tried that one.
I'd say
I know the
no.
developer.
Yeah, I'm not a buyer that came up, but I'm certainly a renter that came up because you don't have an option right now. You know, for a decent place in a decent neighborhood, the rental market has just gotten, you know, insane. It's way more shocking to me, the rental numbers than the condo numbers right now. And, you know, we hear from so many people, and I have so many friends who, you know, signed these deals during the pandemic that are now having sticker shock to what they're going to have to pay now. And I think that's why you're seeing, you know, this inventory and low vacancy rates. You know, if people did lock in during the pandemic, they're not really in an urgency to move.
What
Unless-
segment of the market are we? What are we
John,
talking about?
John, hang on a second. John, hang on a second. Let me just continue on that point. Sorry. So this is March. What's going to happen May, June, when it's the height? Is a ton of inventory going to, I mean, because people are going to be moving and leases are coming up. What do you guys anticipate happening then? If it's that bad now.
So we're starting to see it happen now, actually. So a lot of people entered into 2-year leases, right, during COVID or kind of post waning COVID. And those leases are coming up. And those leases might be at $60 a foot or $65 a foot or $70 a foot. And if they're in prime neighborhoods in Manhattan, those tenants are now getting, you know, renewal leases at $90, $100 a foot. And what are they doing? They're not renewing. They're moving. So like I mentioned the Smile earlier, we have all these people coming from like prime neighborhoods in Manhattan, like seriously prime neighborhoods, coming up to 125th and Lexington because they can no longer afford their apartment.
Mhm.
Someone else will come in. There's a lot of money in this city, and you know, rents are literally approaching $100 a foot in many areas. But they're getting filled by new tenants, and then the old tenants are moving to, you know, that's quite quote unquote secondary neighborhoods to get a better deal. So you know, there's not a lot of inventory coming on. I can tell you
As
that.
a consequence, that puts a floor on the sale market, right? The
It's
sale
good.
market only drops so much because
That's
it's an alternative.
That's right. Well, that's why you're seeing so many parents buy with and for their adult children, because their adult children are coming to them saying, I can't afford to rent an apartment. It's actually cheaper to buy something right now than rent something, even with interest rates going up. And at least you know, as I learned long ago, at least you're paying your own mortgage and you're not paying your landlord's.
Right.
Yeah.
So I want to understand, are we talking about at the $5,000 a month level and the 10 and the 15 and the 20? All of those price points are equally hot?
I would say so. I mean, you know, the upper segment of the market, like 20,000 and up, sometimes goes through blips. But I mean, Laura was talking at Biz Now this morning, you know, find a 1-bedroom apartment in Manhattan for less than $6,000 a month in a good building. Not so easy. Find a studio apartment for less than what, Laura, 4,500?
Yeah, 4,500. I mean, and that's what we're seeing. You know, you asked about the high rents, the 10,000s, you know, 7,500. You know, people are often doing shares or doing roommate situations in an $8,000 2-bedroom because they don't want to pay $5,500 to rent, you know, in a luxury 1-bedroom. And so it gets them into those, you know, high rise, ultra luxe, amenitized buildings.
So I want to just do some quick math. I know you guys can do it with me, but I'm thinking if I've got $1 million worth of real estate, I can buy maybe that studio apartment and I can go rent it for $4,500 a month. Is that still true? Is that about what we're talking about? For every $1 million worth of real estate, I should be able to get $5,000 a month in rent? Is that, because that's an adage I used to use out here in Connecticut. Oh, you got $1 million condo? Yeah, I think we can rent that for $4,000 a month. And that has come up to 5.
I mean, I think it depends on the unit. You know, $1 million, you know, could be spent in several different ways. You can buy $1 million studio right now in a building like One Wall Street, for example. And then, you know, on the resale side, you could probably buy $1 million, you know, maybe very small 2-bedroom in a different submarket. So I think it really depends on, you know, the building and the location. But
I'm just
yeah,
looking at a cap from a cap rate point of view. At what point does that I say, you know what, it's better for me to go buy than to pay that $6,000, that $7,000 rent?
absolutely. I mean, I just did that math on my own as I was looking at places. I thought, should I be looking to put it all in and buy a studio? And yeah, I would say that 5,000 mark is correct.
In New Canaan right now, it's $15,000 to go rent 15 Richmond Hill, but the purchase price on that last week it traded for 2.25. So for 2.25, you could buy it, but for the last 3 years, that house has been renting for 15. So that's why people are starting to come in and say, you know what, I don't care if their interest rates are 6%.
Right.
I'll go get myself a 5.1, a 7.1, and you know, and I'm still better off than renting.
Right. 12 years of rent.
Exactly.
Are any projects in trouble? Like big loans coming due, like just to the, you know, situation, they have a loan at whatever percent and now it's 2 years later and it's coming due.
There are definitely some projects that are in trouble, even if they haven't publicly stated they're in trouble. You know, One Wall Street is a behemoth of a building with hundreds and hundreds and hundreds of apartments to sell. They just hit 15% sold and started closing. So what are they, 600 or so apartments? So
Yeah.
if they've sold 45 of them, it means they have, you know, 500 plus apartments to still sell. You know, in a rising interest rate environment, that's going to hurt. The West is another one, you know, that has over 150 or so apartments to sell. They're not doing very well, and they've got to be feeling the pain. You know, there are definitely some projects out there that are, you know, feeling the pain, because most construction loans are floating rate loans, right? So they've been going up and up and up. So, you know, a lot of these developers have replaced their construction loans with inventory loans, but those are also floating rate loans. And so those loans are approaching 9-10%, maybe more. They're going to feel the pain without a doubt.
What about the Extel project that's down by the Brooklyn Bridge? What is that? The tall?
That one's actually been I'm sorry. That one, you know, again, 800 apartments. You know, they've got a 421A tax abatement, the basis in the land was really low. Their money's a little bit cheaper, but I can't imagine that they're making the returns on it. A lot of developers, unfortunately, they may be out of the money, but they're still collecting fees every month for their management of the project. So that's how they make their money. Kind of how Harry Mackwell makes most of the money he does on his projects, even though he's out of the money on them. That one can't be doing great on an ROI basis, but it's probably performing okay for Excel itself. He has another site there that he bought from JDS that he's not even going to be building right now. They've decided to hold on and not build it right now. So that tells you something.
Where do you guys see inventory in a year, 2 years with regards to new development? I mean, are we going to be in a more ample place with supply, or do you think it's going to just retain itself? I mean, stay low?
I think it's going to stay low. The pipeline, when we look at pipeline, we look at buildings that have been talked about and also confirmed, and the pipeline's not huge. I think there will be a few launches this year, but we're seeing more boutique buildings come to market as well. And I think if activity stays strong, then the inventory is going to remain low.
So I have on the screen in West Chelsea, New York. Is that the XL building you were talking about?
No, this one, formerly known as the XI, this was developed initially by HFZ. They got foreclosed upon, and Witkoff purchased it and is now completing the development.
Is it a hot building that just got into some financing trouble? I mean, through no fault of its own, or is it a tough neighborhood to sell in?
It's not a tough neighborhood to sell in, but when your basis in the land is over $1,000 a square foot to start, and you're building, an expensive product, and the market turns, that's what I was talking about earlier. You're like you can get wiped out in 2 seconds. This project had a lot of problems. It was, I think, overly aggressive price-wise. They had a very high basis for the land, a very high construction costs, and then, unfortunately, there was a lot of publicized potential shenanigans going on with money changing hands.
And how is it doing now with Witkoff?
I'd say fair.
Yeah, I would say it's fair. I mean, as Steve kind of mentioned it, it's been out there for a while, and there's some stories out there about it, which I think have hurt it in terms of sales, and it's very expensive, but it is a great location. Obviously a very unique design. I think it's still there.
I mean, a few Brown Harris Stevens brokers have sold there, and they've actually gotten some pretty, I'd say, good aggressive deals for the buyer. So they're doing, the buyers are doing well. I don't know that Witkoff's going to do very well with that project at the end of the day.
And what's your perception of Hudson Yards? How has that done as an overall destination?
I mean, there have been a lot of sales at Hudson Yards lately, but they're not hitting their numbers, not even close. So I would say that, again, on a market, from a market perspective, they've underperformed. But the finances of that job are so weird with the city and tax credits and everything else. I don't know how it's performed for Related. But remember, Related owns the other side of that as well, which they still have to develop. So I don't know. I would say that Hudson Yards has been less than a success to date. Maybe on the rental side, it's actually done better.
That's what I was going to say. Their rental, they're getting, on their rental side, they're getting like 110, 120 a foot. In some of their buildings, they offer some furnished rentals. I think
it's not much of a neighborhood. Who's the buyer?
A lot of foreign investors over in Hudson
A lot
Yards.
of foreigners, a lot of kind of Related followers, who buy every Related building. I have friends who work there who actually moved their businesses there during COVID and got some pretty good deals. They would tell you that it's not the most convenient place to be.
Mm-hmm.
Have you seen Indians? I asked this earlier, but you didn't hear. Have you seen many people from India?
That's a good question, Roberto. With the amount of wealth in India, you would think that there would be more investors and buyers from India in New York. They tend to go to London. They don't tend to come here.
Why?
It's, first of all, it's more convenient, it's closer. Obviously, there's a relationship between India
And there's a tremendous cultural presence there.
Yeah, there's a big cultural presence. We see some Indian, but not a lot. It actually, it's a marketplace that we've always like wanted to get more out of, and it hasn't happened.
Yeah.
Are you saying we need to have more Indians to get more Indians to be more like
I
London?
think we need more exposure to India, and I think we need to find a way to
We need more
find
direct
the local
flights. That's what we
influencers
need.
to bring those buyers to our marketplace.
More direct flights will do it.
Well, that's probably true too.
This was great. Thank you
Yes.
so much. I guess I learned a whole lot that not every super tall is built equally, that you really do need somebody like Laura crunching the numbers. That's what you do, right? You're the analyst, the
Yes.
analyst ace who can advise us a Tishman Speyer or a Zeckendorf and tell them, no, there's a risky bet. And a lot of these guys are making risky bets with $1,000 a foot land, and they're not paying off, especially in a challenging interest rate environment. So, but I also learned that some of them, like Zeckendorf, have on the boards planning new projects going forward.
Yes.
They're not discouraged. They're still building, and they're still bullish about the high end of the New York economy.
Yeah, listen, builders, developers need to develop, they need to build. The problem what we've had the last couple of years is there's been a lack of land sales because the sellers just have unrealistic expectations of the value of their property. I have to leave you with this. At the BizNow conference today, an investment sales expert was talking about there are a lot of loans coming due that will come due over the next year or so. And he thinks that this summer, you'll start to see property owners soften their ask in order to move things because they're concerned that they won't be able to refinance them and they'll get caught underwater. So, you know, the person that owns a parcel worth $20 million asking $30 million with $17 million in debt on the property may actually finally take $20 million instead of waiting for $25 million.
Are there going to be deals for regular people like Laura and I?
I don't see deals coming in the rental market at all until significant inventory comes to the market, and that's not happening anytime soon, particularly now that we don't have a tax abatement program. But I do think there'll be deals in the for sale marketplace. I actually think there are deals right now, particularly in the co-op market, which I think is completely undervalued.
At the $2 million, $3 million level, there's deals?
Absolutely.
It's all relative, John. It's all relative.
All right.
Guys, thank you so much. This was an amazing hour. Like really.
My pleasure. Thank you guys.
Beyond what I
Great. Thank you,
anticipated.
guys.
We got a lot done. Thank you,
Yeah.
guys. This is a great show.
Thanks, everyone. Have a great
Yeah.
weekend, and happy to do it again.
Happy birthday, Allie.
Let her know.
Happy birthday, Allie.
Thanks, guys. Roberto, Allie wants to know if you've got a birthday referral for her.
Oh, I'll find one. I'll get
All
one.
right.
Thanks, everyone.
Take care,
Bye, guys.
Bye.
Thank you.